What is the dollar milkshake theory, and could it cause the next global liquidity crisis? In this video, I will go over Brent Johnson's theory on the dollar having its stronghold on global financial markets. Of course, none of what I say is financial advice. Please contact your own financial advisor on what's best for you, as I am still new to this, I'm still learning, but at least I'm going to give my opinion on it and try to explain it as best I can. It is important for anyone to not make any financial decisions based on what they watch in this video, as this video is strictly for entertainment purposes only. Now, let's jump into this. I tend to talk about the US financial system quite a bit, and there's a reason for it, and that's because it's the world reserve currency. World trade is mostly settled in US dollars. Central banks hold the reserves in dollars as assets on their balance sheets, and most foreign debt is issued in US dollars, in what is known as dollar-denominated debt. It is the currency that currently everything financially revolves around. The US dollar, just like every other currency, is a debt-based fiat currency in which nothing backs the creation of it other than our ability to pay back the debt. However, that still remains a half-baked idea, considering that with every new issuance of currency comes debt with interest. And that is why global GDP stands at $96 trillion, while the global debt stands at $303 trillion. Now, million, billion, trillion, these are all kind of mind-numbing numbers, and you don't really know what they mean or can even comprehend what they mean. But if I were to put those numbers into seconds, a million would equal 12 days, a billion would be 31 years, and a trillion would be 31,688 years. Wow, that's a lot. A trillion is by far no small number, especially considering that our global debt is 350%, somewhere around there, of yearly GDP growth. With many fiat currencies around the world losing their purchasing power over the years, just like with the dollar having lost more than 96% of its purchasing power since the creation of the Federal Reserve in 1913. So what exactly is the dollar milkshake theory? The theory is that even though the dollar is rapidly losing its purchasing power in this inflationary environment, it's losing substantially less than every other currency around the world, as many governments and corporations outside the US opt to raise capital to fund their ventures from foreign investors through the issuance of euro-dollar bonds, as the dollar remains the attractive fiat currency to hold. Not to be mistaken for the euro and dollars, but the euro-dollar is actually dollars that are held outside of the United States. Now, these foreign entities actually need dollars in order to do global trade and pay off their dollar-denominated debt. And it makes it challenging when the US Central Bank, the Federal Reserve, is raising interest rates, aka the price of money, while at the same time going through the process called quantitative tightening. Now, before I go further into that, let me just go back in time real quick back to 2008, where quantitative easing was utilized by the Federal Reserve back in the 2008 financial global crisis, or the Great Recession. And what quantitative easing did was the Federal Reserve actually bought government bonds from commercial banks and non-bank entities. This was to help the economy quote-unquote recover by stimulating demand by creating massive amounts of liquidity for easy lending and new currency creation. Basically an asset swap, where the Federal Reserve would send bank reserves from their asset side, which becomes a liability for them, to the commercial banks, and the commercial banks would give them their government bonds in exchange. And the Federal Reserve's liquidity is what are called bank reserves, and they can print it out of thin air. Now, quantitative tightening is the reverse, where the Federal Reserve will sell the bonds back to the commercial banks and remove those bank reserves off their balance sheets and reduce the overall liquidity within the financial system, which restricts the creation of new loans in order to reduce the amount of liquidity in the economy. One could argue that the expansion of the Federal Reserve's balance sheet from around $900 billion to $8.9 trillion through quantitative easing did little to consistently increase the United States inflation rate, as the United States has this unique ability to be able to export their inflation to other lesser developed countries, because those lesser developed countries need that liquidity, those US dollars, to pay back their dollar denominated debt and participate in global trade. Where it becomes this vicious cycle where the US actually exports their currency, their inflation, and in return they get deflation in the form of tangible goods for cheap prices from lesser developed countries where they need that currency, those US dollars. And it is always at the expense of poorer nations, as what is plotted with this graph of the US global trade deficit, where it dropped below $1 trillion and is now hovering around 800 billion that the country owes to other nations for the goods that was imported into the country. However, this system currently works as long as the debt doesn't matter and the US and other nations grow their currencies at around the same rate. Things start to fall apart when the US grows its currency at a lower rate than lesser developed nations, where they grow their currency at an even faster rate. Then this results in a higher value of the dollar relatively compared to other fiat currencies, like the Canadian dollar, the Japanese yen, the euro, the Turkish lira, the Chinese yuan, to name a few. Almost every currency worldwide is seeing their values decline against the dollar as the dollar continues to rise, and smaller countries are finding it hard to keep up, as they will have to continuously devalue their currencies in order to try to pay back their dollar debt. This then leads back to the dollar milkshake theory, where every dollar abroad from foreign investors, they will see the rise in their US holdings go up, and they will see the US as a safe place to invest their currency. And that's when the US will see this massive drowning of liquidity and possibly see this crack up boom in valuations. If left unchecked, this could create a global sovereign debt bond currency crisis. And with nations like Albania, Argentina, Cuba, Ecuador, Indonesia, Pakistan, Panama, Sri Lanka, Uganda, and even the United Kingdom are experiencing protests due to the higher costs of living. Those higher costs will bring about lower economic growth, as more of the lower and middle class will be directing their capital towards essentials as opposed to non-essentials. Some of these protests can be attributed to the ongoing worldwide energy crisis. For example, in the EU, the Nord Stream pipeline connecting to Russia, feeding Europe, was just shut off. This will heavily affect these countries, including the heavily industrialized economy of Germany, which has fed 58% of its annual gas needs. So you better buy your German car right now, otherwise you might be out of luck. I preached this before, but energy is life. And energy has a direct correlation with the economy. If there's more easy, accessible, cheap energy out in the economy, we will see higher economic growth. Because of the world's dependence on dollars, the BRICS nations, which include Brazil, Russia, India, China, and South Africa, along with many newcomers, are now looking to establish a new reserve currency to compete with the dollar and reduce overall global trade using it. Little by little, we are seeing more and more transactions globally using less dollars and other smaller nations' currencies. Like Sakhalin Energy is now asking its clients to pay them in anything but US dollars. Or Indian companies refusing to do business with the dollar. Or China agreeing to directly trade with Russia's energy giant, Gazprom, to pay for Russian gas in either Russia's or China's currency. So even though it might seem like a great idea to get out of fiat currencies in the long term, in the short to medium term, the US dollar just might be a great asset to have. And right now, I know the popular view is that the US dollar will die through devaluation. However, it seems to be more realistic that the dollar will actually die from too high of a valuation. Well, that's my video for today, guys. I just want to say thank you for watching. If you haven't already, please hit that thumbs up button. It would really help push this video out into the algorithm for more people to see. And don't be afraid to share it with your friends and family too, if you think it's something that would be up their alley. I will see you guys in the next one. whenever that is.